Good day, fellow investors. Stock market investing is broken because of algorithmic trading, passive investing, and even us retail investors. Let's immediately start with retail investors, where NYU researchers Laritz and Wurgler recently published a paper discussing the research behavior of individual investors, and it has been somewhat in the news, where the key is that the median time spent researching a stock before buying is just 6 minutes, 10 seconds is spent on analyzing risks, 2 minutes on fundamentals, and more than 70% of research is spent on checking charts, price movements of 1 day or less. The research factors they have found is that the bigger the company in size, the more it is in the news, the more it leads to research interest from retailers. And also attention is captured by daily returns. If we look at my last videos, of course, the largest stock discussed has had the best viewership. And then if you go away from the US, that's of course the worst video, because very few are interested in not US companies, despite the US being the most expensive market in the world. Here you have from their research what they have found. So Apple was interesting back then because of the iPhone research alongside other big stocks. Retailers mostly look at financial sites to get their information, thus just scratch the surface and then buy something on impulse, we can say. However, there are also limitations to this research. It was done in a 4-month period back in 2007, at least they have the data on clicking. The environment now has changed significantly, but I don't think that investors are searching more these days. There is always the question about the accumulation of previous knowledge that's not accounted for in the study. Dividends, you just look at the dividend, you know what is paying if you are looking for dividend stocks. And in the 4-month sample, they only looked at those that traded. Some maybe didn't do any trades, and therefore those are excluded. Anyway, even the Wall Street Journal published an article that retail investors these days spend much less time than you might think on analyzing stocks. Further, same professors there have also looked at the most recent impact of stimulus on retail investors and stocks, and have found that valuations on retail correlated investor stocks have gone up because of the stimulus. As the stimulus come in to your bank account, those increased stock prices make it even more expensive. So retailers, most of them are not thinking when it comes to investing, and then there is this various data on how much market volume trading is impacted by retail investors. Some say 20, some say 10. I think it's an average of 15 that should fit our picture. The next factor is passive investing, where someone automatically owns the whole market through indexes or ETFs, and the spread is based on company size or weight in the index. And you can see here how passive indexed assets under management have reached 60% of the total assets under management market, pushing away active investing. Also, the number of ETFs and index funds is now 40% just focused on passive, and grew from 25% in 2012. If we look at the strategies there, passive has been growing, active funds have been seeing outflows, and then again, assets under management have now reached 20 trillion of a 58 trillion stock market in the US. Thus, we have retailers not doing research. Passive is all about we trust the market, efficient market theory. So that population of the market is not thinking. Further, we have algorithmic trading. I have asked my assistant here, chat, to tell me what is the estimated volume traded by algorithms. We have 60 to 80% for US equities. up to 80% forex, futures, options, so very high numbers estimated that computers, machine are trading there. You can see here from the 2010s huge jump in equities. This is sourced by Goldman Sachs. So this is the current situation. We have 70% of the market, let's say Algos, 15% of the buying is passive, the buying, and then 15% is left for retail, of which maybe 10% is thinking value investors, what we do here on this channel, which means that just 1.5% of the market thinks, which means that everything else, the fundamentals, nothing matters, it's all about flows. And this can have huge consequences when it comes to long-term investing. The first factor is that price becomes irrelevant, and here we can see the valuation of the S&P 500 that is now 36 for the CAPE ratio that takes into account 10 years of average earnings, and the CAPE ratio was around 15 because that's the ratio that delivered the stock market returns 10% paradigm. Now, if you're paying twice or more than what the average investor paid for those 10% over the last 100 years, you are not going to get 10%, but 5% or less. So that's something that's shifting there. If we look at the dividend yield, the current yield of the S&P 500 is 1.29. The average was closer and above 4, which is almost 3 times higher. Of course, the current situation is exacerbated by the federal funds lowering interest rates over the last 40 years, which is something crazy. And still, you could say, okay, rates are higher now. Rates are still in the stimuli because inflation, I don't see it at 2-3%. So we are still in positive stimulus when it comes to rates. On top of everything, we have seen money printing that still increases the amount of money in the world. And as we discussed here, it leads to higher and higher prices. But if we go to Warren Buffett, efficient market theory, where few think, as he says, naturally the disservice done students and gullible investments professionals who have swallowed the efficient market theory has been an extraordinary service to us and other followers of Graham. In any sort of a contest, financial, mental, or physical, it's an enormous advantage to have opponents who have been taught that it's useless to even try to think in this case. From a selfish point of view, Grahamites should probably endow chairs to ensure the perpetual teaching of the efficient market theory. And over the last 5 years, the S&P 500 has doubled, not a double in earnings, and it's all based on flows. Let's hope that for all of those invested pension funds, the majority, that all these flows keep going, everything keeps like this. But for us value investors, of course, we cannot take this risk. And I know that mindless investing has been doing great for the last 40 years, but when it comes to us value investors, the goal is to do better than the likely returns of mindless. At best 5%. Maybe it will be 10%, but that will just increase this bubble. We need to lower the risk. We need to get the rewards from the businesses, from the ownership, which we'll discuss in another video this week. Looking for a margin of safety. And yes, that requires hard work, but that's what we are here for. This is the quadrant of the stocks that we have discussed here publicly on YouTube. And in my opinion, this is the risk and reward of the S&P 500, maybe 4% at best at high risk. And then you have others, it's not stellar, but still some businesses that will likely give you 7, 8, 10% long term with much lower risk levels, which is then value investing. Of course, if you want more such businesses, you can check my research platform where we have even better risk and reward situations. So we'll keep doing our thing. Others can do whatever they want, Buffett says that mindless investing is a service to us, so let's hope they keep on doing. I hope for the betterment of humanity that this doesn't end in the disaster, but we'll wait and see what happens. Thanks for watching, I'll see you in the next video.